this morning in one of the headline articles reads, "Inflation keeps inching higher." Key price gauge Wednesday showed inflation continued to edge higher in November. The U.S. Consumer Price Index rose an annual 2.7%, up from 2.6% in October. While inflation has cooled dramatically from the pandemic peak of 9%, its progress towards the Federal Reserve's 2% target appears to be stalling. Nevertheless, future traders are betting central banks will lower its key interest rate next week to between 4.25% and 4.5%. A couple really interesting things, I think, jump off the page at me with reading that. So inflation is inching higher, yet Federal Reserve wants to lower interest rates. That's inversed from the standard playbook. I find that to be intriguing just in itself. Then when we really start to pull back the curtain on inflation, as we know, the two stickiest forms of inflation are energy prices and wages. So borrowing costs are absolutely in there, and they will move the needle a lot. But the two stickiest forms of inflation are energy prices and wages. What absolutely blows my mind is we have 5 global wars going on right now, and WTI crude, which is the U.S. market way to evaluate standard crude prices, it is for the year, it is down 2.7%. So we are actually spending as a country 2.7% less for our crude oil, which is going into your cars. That's the primary form of energy here in this country. It's oil and natural gas, but oil is still numero uno. So the fact that our oil prices are actually down over 2.5% and still inflation is going up is very interesting to me. And if we weren't manipulating energy prices so much globally, we would be paying a lot more for our energy prices. The fact that through Russian sanctions, they're still allowing Russia to sell Russian oil at $60 a barrel is indicative of how important energy prices are to the global economy. So obviously with Syria falling recently, that's going to disrupt some oil production. Russia getting kicked out of Syria is really going to change things because Russia is using Syria as a base to do a whole bunch of stuff in East Africa. Obviously, a whole bunch of resources come from East Africa. So the whole world is going to rebalance here on a lot of things with this much conflict going on. Israel just took out a ton of ammunition depots in Syria. We'll see how the new Syrian government takes that. Hopefully they view it as a good sign. Israel and Turkey are partnering on that. But to get back to the real meat of this video, again, we hear that much global conflict and energy prices down. So take note of that. That is a historic, massive outlier. And then when we talk about the second thing, and this is what is indicative of why, in my opinion, inflation is going up and it's going to keep going up because of labor dynamics. So wages grew by 5.6% in October from the previous year. That is from the U.S. Bureau of Economic Analysis. So that's a pretty straight up metric. 5.6% year over year wage growth for the average labor here in the States. Obviously, that's a big number. 5.6% is well over the 2% target that the Fed funds rate has for our inflation, our goal inflation number. So, I mean, that's 3.5 percentage points above that. That's a pretty big delta. And what scares me the most, and you can see previous videos even from this week, I have not seen the labor dynamics rebalance. It is a supply and demand equation. We are still so far away from equilibrium, not only for specific dental office jobs, but dental trades like we've talked about, plumbers, electricians, carpenters. Wages are going to continue to go north at alarming rates until we can get that rebalance back. So another thing that I really find intriguing on the borrowing cost aspect is this. So the Fed funds rate is selected by the Federal Reserve. They come together as a unit and they pick that number. However, most of the borrowing rates in this country are based off the 10-year Treasury note, not based off the Fed funds rate. So even with the Fed funds rate going down, borrowing costs have actually stayed flat because the 10-year Treasury note has the yield on that is actually going up. And it's a really interesting reason why. And it's back to geopolitics. So With our big trade imbalance with China, historically, China and Japan have bought a whole bunch of US treasuries. Well, those countries are now de-dollarizing and they're selling US treasuries. If sovereign countries are not buying US treasuries as a store of value, and now institutions and retail investors are having to pick up that slack to buy these US treasuries because that's how the government borrows all this money. We do it through selling treasuries. So we have to keep the treasury notes going because again, that's how we're funding this $2 trillion deficit is through treasury notes. So if we have to continue to increase the yield on our treasury notes so investors and retail buyers will buy them, borrowing costs are going to keep going up, not going down, regardless of what the Federal Reserve does. So I think that's a very interesting thing for us to think about at home because it's easy to just say, oh, we can stimulate growth by lowering interest rates. Well, not if the 10-year note is not following suit. So keep that in mind as we're watching this thing develop. Two other real big borrowing metrics are the LIBOR rate and the SOFR rate. So LIBOR is about 4.96% as of this morning. SOFR is about 4.6% as of this morning. SOFR is the rate that banks borrow between each other. Basically, LIBOR is similar to that, but those are uncollateralized loans, which is why they're about 300 basis points, a little bit, 30 basis points, a little bit higher because there's more risk on uncollateralized loans versus collateralized loans. And as we all know, the world is two things, supply and demand and risk portfolios, right? The riskier it is, the more yield you'll get. The less risk it is, the less yield you'll get, at least when we're going on logic. A couple of these things that we've talked on today, we are getting off the logic train. So comment down below. Let me know what you guys are thinking. Let me know, how do we get the labor back? How do we get supply and demand equilibrium back again? I love seeing wages go up, but then quality and production or efficiency is going to have to match. So a lot of people are betting on AI. We use AI here at Lad Dental Group, but it is far from even replacing jobs. It's augmenting jobs for sure, but it is not to the point of replacing any job in the dental sector. So again, comment down below. Hope you guys learned something today. And stay tuned for more of these live videos. Jesse, I appreciate the comment. Game over. I hope it's not game over. Man, it's been a massive ride though. And the fact that we're feeling some struggles here in this country is interesting to me. I was reading some overall stock valuations as well and overall market valuations. The US stock market is like 80% of the global market. Our PE ratios are off the charts. We are in a speculative market of almost every single asset here in this country. So it's going to be interesting to see where we go from here because I don't know, we can't keep borrowing and printing money at this rate. So we're eventually going to have to actually get back to efficiencies. We're going to actually have to get back to productivity. And I just don't hear a lot of rhetoric still on those type topics. So maybe that's why we'll be making more of these videos. So I appreciate the comment, Jesse, and I hope everybody has a really good Wednesday on this chilly December here in Indiana.